East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin, and it's Friday. We're finally here. The futures are looking up a little bit today. We've seen volatility once again, things being down by a few hundred points for the Dow to being up a few hundred points, and now you're looking at the Dow futures up by just over 80 points. S&P futures up by 17, the NASDAQ up by about 75. Treasury yields is where much of the focus has been, and this morning you're looking at the 10-year at 442, the 2 years at 383. Again, keeping a very close eye on that. And we do have PPI coming up at 8:30 this morning after the CPI numbers we got yesterday. Earnings season kicking off this morning. BlackRock reporting earnings of $11.30 a share. That beat the expectations of $10.14 a share. Revenue came in below estimates despite rising 12% to $5.28 billion. You can see that stock is up by about 1.3% this morning. And the CEO, Larry Fink, is going to be joining Squawk on the Street. That's coming a little later this morning in the 9 a.m. hour at 9:30. J.P. Morgan also reporting results today, and those numbers did come in above expectations. $5.07 a share for the earnings per share. That was versus the $4.51 the street was expecting. Revenue also beating expectations at $46.01 billion, and that stock is up by about 1.7%. Then you've got Wells Fargo reporting earnings of $1.39 a share, revenue of $20.1 billion, missing expectations. That stock up by 0.75%. And Morgan Stanley rounding things out. It had beat on both the bottom and the top line. Earnings came in at $2.60. That was 40 cents better than had been expected. Revenue beating expectations. That stock's up by about 2 cents. We'll have a lot more on these numbers and what these CEOs said about what they're seeing right now, what they anticipate in the months to come.
Meantime, I want to get straight over to senior economics reporter Steve Leisman. He's got a special guest for us this morning, sir.
Andrew, thank you. We're pleased to be joined this morning by Neel Kashkari, the Minneapolis Federal Reserve President. Neel, thanks for joining us, and I can't think of anybody better to be here because of your experience both at the Minneapolis Fed over many years, but also from investment banking as well as your role in the Treasury during a particularly interesting time, the great financial crisis. So, Neel, I usually don't do it this way, but I just want to ask you broadly, how are you feeling about the economy right now and financial markets given all of the changes that are going on? I'm going to ask you the most open-ended question I've ever asked a Federal Reserve official.
Well, good to see you. Thanks for having me. It's hard to get a read of what's happening underneath. You know, it's really important for the Fed. Obviously, we're very focused on inflation and employment, trying to understand we've got an uptick in inflation expectations in the near term. It's our jobs to make sure that that does not translate into a long-term increase in inflation expectations. And so I'm paying attention to the same market moves you all are. The bond market, I'm paying particular attention to try to understand what is it telling us about the underlying inflationary dynamics. And it's a complicated thing to analyze.
Before you get to the inflationary dynamic of the bond market, Neel, one of the remarkable developments has been this, that at a time when there's concern across the globe, the general trade has been to trade into U.S. assets as a flight to safety. That's not happening now. The dollar is selling off this morning against a broad range of currencies. Yields have been elevated. Is it curious to you, and what is it telling you, that there is no obvious or traditional flight to safety in the current environment?
Yeah, I think your observation goes to the heart of the matter, and I always go back to fundamentals. Why do we have a trade deficit in America for decades? It's because this is just the math of economics. Investors around the world have viewed America as the best place to invest. And if that's true, we will have a trade deficit. And so now one of the ways that expresses itself is in lower yields across asset classes in America. So if the trade deficit's going to go down, it could be that investors are saying, okay, America no longer is the most attractive place in the world to invest. And then you would expect to see bond yields go up. Now, it also could be inflation, and that's why this matters a lot to the Fed. I'm not seeing evidence yet that long-run inflation expectations are climbing, and it's the Fed's job to make sure that that doesn't happen. But I would expect to see, if investors decide, hey, we want to invest elsewhere, all else equal, that ought to be pushing up yields, and you'd see that in what we call the term premium.
Neel, can I just throw one other possibility on that? These are pretty short-term moves. We hope they don't become longer-term moves. Could it be a reflection of hedge funds and others that were leveraged and needed to sell things as equity markets dropped, selling the assets that are most liquid and trying to make sure that they have the cash to pay whatever comes?
Certainly, there's a lot of, you're right, Becky, there's a lot of complexity. The basis trade has been getting a lot of attention. But I would just point to something that Steve mentioned, which I think reinforces the story a little bit, and that is that the dollar has been weakening. Normally, when you see big tariff increases, I would have expected the dollar to go up. The fact that the dollar is going down at the same time, I think lends some more credibility to the story of investor preferences shifting.
Neel, let's talk about things that we never really want to talk about, which is this idea of what's happening in the financial plumbing. And those are the calls that I make to people to say, hey, how is this stuff happening? And when I say financial plumbing, what I mean is the reason why you can have your paycheck direct deposited and then withdraw cash at the ATM machine, the pipes that connect those two, that's the financial plumbing. And it's all around the globe for the dollar. I made some calls to people, Neel, and one guy said to me, we're not the story now, but we're getting closer. So give us your idea or your sense at all what's happening inside the financial plumbing. Does this rate in a way that was near or close to what happened in the pandemic, or are we still far away from that and we shouldn't be worried about that?
I think we're quite a ways away from that. I mean, during the pandemic was so unique because the virus was so unknown and how dangerous it was so unknown that people fled all sorts of assets, stocks, bonds, everything, corporate bonds, treasuries, and they just wanted cold, hard cash. And that's where the Fed had to step in a very profound way to flood the system with liquidity. Ultimately, we have the ability to manage some of these transitions. So if there's a dislocation, I'm not forecasting this, but if there were a dislocation, we have the ability to smooth out that dislocation. But going back to the discussion on yields, we're not going to be able to change where yields ultimately settle. All we can do is make that transition path a little less rocky. But the settling of where yields end up settling, that depends on trade policy and fiscal policy and U.S. economic competitiveness.
You don't want to stop.
That's out of the Fed's hands.
You don't want to stop the market from getting to a new equilibrium that it wants to be at. You can only smooth the transition there.
Correct. We don't have the ability to stop it settling or wherever it wants to settle. All we can do is smooth the transition if there are big dislocations in markets. But I'm not seeing big dislocations yet. I'm seeing some stresses, but markets seem to be adjusting okay so far.
Neel, I didn't like either scenario for why what was happening was happening. You know, one, inflationary expectations are going back up, or two, we're becoming less attractive as the place to invest. Both sound, I can't even pick. That's like a Sophie's choice. Given the number we saw yesterday, you think that was an outlier, the CPI number, or does that make it even more troubling that there probably isn't a reason to ratchet up inflationary expectations? So then the only answer would be that that we're less attractive as a place to attract capital, which I don't think we want that. I don't think the Trump administration, at least if it was explained that way, I don't think they'd want it either.
Well, when we dug into the CPI data, there was a lot of good news under the hood. One of the biggest drivers of the high inflation of the past couple of years has been housing. We've done a lot of analysis that said as new leases turn over, the housing inflation ought to be coming down. That trend seems to be continuing as we expected based on the new lease data. So I think the fundamentals of the soft landing of inflation have been in place. It's been continuing. That's been good news. But given the big moves in trade policies over the past few months and the market dynamics that we've just been talking about, it's pretty stale pretty quickly. And I think even the tariffs after the pause, the effective tariffs are still 100-year highs. And so that suggests that inflation, at least in the short term, will be going back up again. And it's our jobs to make sure at the Fed that it does not lead to long-term inflation.
Yeah, Neel, when you say that, people hear that in a kind of clinical monetary policy way, the people who are very attuned to your speaking and Fed speak, which is that given the concern about growth, both sides of the mandate, the growth side of the mandate or the employment side of the mandate and the inflation side, you're going to take care of the inflation side first. Is that a correct read of what you're saying?
That's my read of things. You know, if we hadn't had 4 years of high inflation, I would be more comfortable taking this quote-unquote look-through on inflation policy, which is if there's a one-time consumption tax increase or one-time tariff that pushes up the price level, there's an argument to be made that that's a one-time effect on inflation and just look through it. I would be more sympathetic with that view if inflation had been around our target for the past few years. But coming into this with elevated inflation for 4 years, and it's still elevated today, that makes me quite nervous about taking that one-time look-through approach, because we have this possibility of unanchoring of inflation expectations where people lose confidence that we're really on the job. And I've heard many of my colleagues speaking in the past few days also echo the focus of we have to make sure that long-run inflation expectations remain anchored. And so for me, that's got to be job one.
Neil, we've been having conversations all week about private credit. We spoke earlier with the CEO of Apollo, Mark Rowan. I'm curious how you think about the universe of private credit and loans through that mechanism, given the connection, talk about financial plumbing, back to the traditional banking system, which is to say that banks, in the last couple of years have gone, as much as they can into trying to provide leverage, if you will, into the private credit system, and how much we should be talking about that or not.
I've dug into it quite a bit. Anytime we see an asset class grow as quickly as private credit has, it raises concerns is some systemic risk building. My analysis says that private credit funds generally are much, much less levered than banks. Say if a bank is 10-to-1, a private credit vehicle might be 1-to-1 leverage. And the sources of systemic risk are traditionally the intersection between leverage and maturity transformation, so borrowing short and lending long. The private credit funds that I've studied generally have much longer term funding. And so right now, I'm not seeing a systemic risk building in private credit, though it does represent leverage, and leverage across the economy is itself a source of economic risk, but I'm not seeing as much evidence as a source of financial stability risk that one might be worried about. So, bears watching. I don't want to declare all clear, but I don't see the fundamental kindling there that would suggest that it's particularly risky.
Neil, let me ask you a different question, which maybe has to do with just the strength of the economy and how you see these negotiations playing out, and therefore sort of what the Fed does or doesn't do about them, which is to say we've now had a bunch of sort of deal-making conversations at the table about if you are an ally of the United States or a supposed ally and you're supposed to be making a deal, to the extent that some of these countries say, you know what, we're not going to do this, or we're going to take much more than 90 days, or we're not going to make a favorable deal, whatever. It just doesn't turn out the way you'd want. I'm taking the most negative perspective of this, not from a political perspective, just as we're sort of like trying to figure out the risks of all of this. And so the question becomes, is there a Fed put on those negotiations, or is there an administration put on those negotiations, or neither?
Well, I certainly, Andrew, can't speak to what the administration will do. That's obviously up to them. And as Steve and I were talking about a few moments ago, the Fed cannot change the ultimate destination of where the economy is going to settle. All we can do is keep inflation in check and try to keep dislocations from disrupting that transition period. And so we're going to watch all of this very carefully and try to get inflation all the way back down and keep the labor market strong. But as you all have talked about for many, many days or weeks, a tariff pushes up inflation and on the margin pushes down economic activity. So it puts the Fed in a particularly challenging position. That's what we have to focus on. And those are the only tools that we have at our disposal.
Neil, I'm interested in timing as to when and how the Fed can respond. I can count on one hand minus three fingers the number of times that I've gotten a call from a Fed official saying they didn't say what they meant. And so when the Fed chair says something, I think he means it. And what he said last Friday was inflation over the coming quarters. And this question is about how long do you need for the inflation numbers to clear before you're confident enough to address the growth side of the mandate, that you're sure that this is a one-time increase in the price level, Because when I hear coming quarters, that brings me to like October, and I see the market priced in with rate cuts in June. So is the market overestimating your ability or the timing of your ability to feel confident that the tariff impulse is a one-time increase to the price level?
Well, I think answering your question, Steve, goes back to Andrew's question and Andrew's comment, which is it really is partly going to depend on how the negotiations go. If we see that deals, attractive deals, or whatever the deals are, happen very quickly, and we have some confidence of where the tariffs are going to settle, the U.S. tariffs and our trading partners, then I think that would give me more confidence that whatever these effects are going to be shorter-lived. If the negotiations take a long time and that there's tit for tat and back and forth, and this is going to be an ongoing negotiation, then it'll take me more time, at least speaking for Neel, more time to reach that level of comfort. But you've heard over the past few days, most of my colleagues have come out and said, inflation is job one. We can't let inflation expectations get unanchored.
Neel, let me ask you about something you were just mentioning. Inflation expectations have tempered somewhat because of the housing component coming down, but mortgage prices have jumped pretty substantially this week. Our colleague Diana Olick, who covers the housing market, had a story that lays out another potential problem with this. The Chinese are big owners of mortgage-backed securities. They've already been dropping their positions on that. I think as of the end of September, it had dropped by more than 8% than where they started the year. By the beginning of December, it was down 20%. If they decide to retaliate by dropping mortgage-backed securities, what would that in turn mean for pressure on the U.S. housing market and inflation along with that?
Well, I think mortgages, when we do quantitative easing, we've done both the mortgage-backed securities and the treasuries. They tend to be quite linked, and not perfectly linked, but they are linked. So I think over the treasury market and the mortgage market, you would continue to see yields continue to climb. And that'll really put a continued freeze on the housing market. So we've seen a dearth of activity in housing. It's been expensive for buyers to come in. There have been very few transactions. I think you would continue to see that happen. And in some sense, you might push up inflation a little bit, but if sales aren't happening, it's not clear to me what that'll end up doing to prices. I think more likely you just see less activity, and it'd be somewhat of a drag on U.S. economic growth because the housing market itself is an important sector of the U.S. economy in terms of building homes and furnishing homes, et cetera.
For people who want to buy a house and have been saving and thinking they get to that point, that's a deal killer.
It is. It's a real challenge, and you end up just having a frozen housing market per se. The longer the mortgage rates end up being higher, the higher that mortgage rates go.
I guess I'm back to thinking about that number yesterday and on where the risk really is now, whether, with your dual mandate. And the response of the markets to what some are, for lack of a better term, calling the Trump put, backing away, it was... I think it'd be scary if the Trump put didn't work, if he was unable, if the administration was unable to stop it. I also worry about times in the past when we thought we had a Fed put, and there have been times where you gave the market what it wanted, and you know how the market goes down, the next day, sometimes that happens. But I think the combination of the Fed and Trump, a Trump put could do it. Why not do it preemptively? Why not? If you're at 3, and there's a possibility, it would be bad to get to the point where you have to come in. If the dollar gets worse, or if the market, it's Friday, things are okay so far, but I think we're on tenterhooks that this could start to get out of hand. Why not do it now if we're not restrictive anymore?
Again, just speaking for me, I'm not somebody, even though I was at Treasury during the 2008 crisis and I led the TARP program, I think, you remember that. I think that the Fed or Treasury stepping in should be done reluctantly, should be done when it's only truly needed, not all the time. And right now, short-term inflation expectations have increased. We've had 4 years of elevated inflation. I think we should be very cautious about taking moves that potentially could demonstrate a weakening, which I don't believe is there, but a weakening of the Fed's commitment to get inflation all the way back down. I think we need to finish the job on inflation, and then we'll be able to get back to the traditional trade-offs of the dual mandate goals. And for me, for one policymaker, I'm not there yet.
Neel, I've been saying this out of what I think is my knowledge of the Fed, but before you did anything on an emergency basis, Is it fair to say that you guys feel like you have a bunch of programs available that are already in existence that you would prefer to see the markets or market participants turn to before you did anything on an emergency basis? And I'm talking about standing repo facility. I'm talking about swap lines and that kind of stuff. Do you feel like you're prepared for any kind of thing? And is that something that is should be thought as being helpful for the market, that these things are already there?
Oh, that's a great point, Steve. Absolutely. I mean, the discount window is always there against a wide range of collateral. Just as you said, we have the new, what we call the ceiling facility, the SRF, that is there to provide reserves against Treasury collateral if needed. So there are tools there to provide more liquidity to the markets on an automatic basis that market participants can access. So that's in addition to the swap lines that you talked about for global financial institutions. So those tools are absolutely there. And we also monitor activity there, and I'm not seeing much activity there yet either. And so that's a great point. Now, if you remember when Silicon Valley Bank blew up, there was a unique situation where the risky assets that are normally not risky were the source of the instability. And then in that moment, the Fed was able to stand up what we call the BTFP, the Bank Term Funding Program, designed specifically for that scenario. No, we don't have the ability to design a facility to offset the economic impact of tariffs. There's no tool that does that, because tariffs push up inflation and push down activity.
Neel, thanks for. I would just point out those programs did not exist in 2008, and those things have been stood up.
That's an excellent point.
And remain there. So there's a whole bunch of things that are out there that maybe is the reason we're not hearing. Neel, thank you so much for joining us this morning.
Thank you for having me.
Neel Kashkari, I think if I was a New York Post headline writer, I would say, Fed to White House, Donnie do a deal.
Well, and I think that's the other,
No, that's not what he said, just to be clear.
But to the question that Joe asked, why wouldn't you do something preemptively? I don't think they want to encourage the policies that they've seen to this.
Well, I think they're neutral as to these policies. They will take the policies, but when you asked him, could they cut rates? I can cut rates, and I can foresee cutting rates depending upon the negotiations.
And depending on the inflation.
I just think inflation with what's happening.
I hear what you're saying. You want them to go on the come based upon what they say.
I don't think inflation is our problem right now.
Yeah.
But what do you do, Joe, if you got these things coming through?
I don't know. I just get scared when we start talking about puts, because I don't think people really. You can stop this, either the Fed or. Well,
what would be worse is what you alluded to.
Right.
What if they did
We've seen that before. Remember, we've seen that before.
And it went down. Right.
Everybody's hoping for Fed to go, the Fed to go 25 or 50, then they go 50.
They have never failed at it. It just
the world can only end
they
once.
They just ask for more.
That's what Art Cashin said.
The world can only end once.
Happens only once. It's a trade you have to time very carefully.
We didn't get to this, and the question I was going to ask him, which, by the way, he's not even the right guest to ask, but I don't know who to ask because of all the news that we've seen. I didn't see this front page story until a half an hour ago from the Wall Street Journal about Chinese officials basically signaling that they've been behind these infrastructure hacks for the last few years with officials, U.S. officials in December, the Volt Typhoon ones, that basically said, that's been us as a threat to say, keep it up with Taiwan.
If you didn't ask Neel that question, he wouldn't have answered.
He doesn't have an answer. He doesn't have an answer for it, but I don't know who else to ask, so I'll ask you guys.
Rock box is going to black. We'll be right back.